Okay, let's start here now. All right. Okay. So this is the actual start of the module. Now here the module content. So as I was mentioning in your lecture notes, in my online lecture notes for each topic, you will find some important information. So here, for instance, we are referring to the week 1 slide. So if it says T1, that means it's the week 1 slides. So we are using topic 1 and week 1 interchangeably. Later on, we'll have to change this terminology because that week 7 material is coming into week 6, or maybe you can just remember it, okay, based on what we discussed. So what's going to happen here, let's start with the slides. And as you can see, there are like 92 slides here. So it's pretty, here, let's look at this, 92 slides. So we will just quickly skip through. I'm going to skip through stuff which is where there's not much to explain. This is just basic stuff which you can read. So the idea is that in the class, because there's so many slides, I don't have time to go through each slide in detail. So you still have to read all the slides, okay? You still have to read everything because the slides are given to you, and you have to still read it. But I will skip over a lot of slides, and sometimes I'll just tell you that you have to memorize the information on that slide. So in that case, I don't spend time on that slide because there's no point. I'm not going to add any value. I will just tell you that, okay, this is some information. You have to read it and memorize it. So let's look at these various elements. The introduction to the tax system. I'm going to quickly skip through this because we don't really have. I mean, you should know about it, but I'm not going to. This is just basic information actually. So I'm not adding much value. You see all these different types of tax that we will be covering. Okay, and so there's one concept here, which is whenever there's some kind of concept to explain, I will spend some time on it because you also have to. So one of the things we will have, you'll see that in the module again, we will be focusing very strongly on your assessments and what submissions you have to make, and your class test preparation, exam preparation. So we obviously want to have a focus on everybody scoring well in the exams and getting an overall good grade. So hopefully you'll do better than last year, okay? Because in law, your batch did the best scores of all so far of the last 3-4 years. So last semester law scores were very good. So hopefully your tax scores will be even better than the last batch last year. So that's one. But at the same time, while we are trying to get a good score, we also have to learn, right? Because you don't want to be getting out of the university with just somebody hanging with a degree hanging around your neck and you got your mark sheet. You need to have some accumulated knowledge, and you need to have the ability to use your judgment, use your industry knowledge. All these things are also very important, and they become more important actually. So we have to learn some concepts. Conceptual clarity is very important. We have to learn various concepts, so we will try to spend some time on that as well. So towards that, we have a discussion on direct taxes and indirect taxes. Okay, so in this list, do you know which is a which is an indirect tax? Does anybody know in this list which is an indirect tax? Okay, so first let's understand what are direct taxes and indirect taxes, and that's why I have some here. Okay, so what happens in indirect taxes? They are levied on products and services, okay? And the most important thing is that the rate is not a function of some legal person's level of income. There should be an apostrophe here. Yeah, okay. So normally what happens is when we have a direct tax, as you will see in the case of a direct tax, the direct tax is a function of your level of income. So if you have a certain level of income, you pay a certain rate of tax. If you have a higher level, usually you pay a higher rate of tax. So those differences exist. But in the case of an indirect tax, it's levied on goods and services, and it's not a function, the rate is not a function of your level of a legal person's level of income. Why did I use the word legal person? If I just use the word person, that means I'm just referring to people like you and me, human beings, okay? If I say persons, then I'm referring to legal to human beings only. But I use legal persons, and what does that mean? What else am I referring to in addition? Companies, very good. So companies are artificial legal persons. That's why I use the word legal persons. So when I say legal persons without any qualification, it means both artificial, all types of legal persons. Okay, so if I say Dufi students, that means that I'm referring to all Dufi students. Okay, but if I say female Dufi students, that means I've qualified the word Dufi students. So now I'm referring only to the female students. Okay, so you should understand. So it basically, legal persons means all legal persons. So I'm trying to include companies also, right? So direct taxes can be levied on companies also, and again, it's a function of their level of income. But it's, in the case of indirect taxes, it's on product, it's not a function of a person's level of income. Direct taxes are a function of level of income. Then additional two terms which I want to introduce to you: regressive versus progressive. Do you know these terms? Regressive tax system versus progressive tax system. Anybody? Okay. So let's learn these terms as well. These are basic concepts in tax, so you should know about them, even if it's not officially part of your syllabus, but you should know about them. Let me just show you the tax tables. Where are the tax tables? There they are. Okay. So what is a so first let me show you what is a progressive tax system. So these tax tables, I forgot to mention the tax tables in the introduction, the module introduction video, but I'll explain it here. Okay. So in the exam, in the class test and in the exam, and obviously in your assignments, you have in the class test and final exam, although otherwise it's closed book, but the tax tables are always provided to you. Okay. So you should get familiar with the tax tables, because while you have to memorize a lot of things, the information that is in the tax tables you don't have to memorize. So you should know what is in the tax table so that you don't have to waste your time memorizing that. That will always be given to you. So all this stuff, okay, what are all this, so you read it and later on become familiar with it. All these tax tables will be given to you. So here in the UK, what you have is, if your income is between 0 and this, 0 to 38, you have 20% tax. For income which is between 38 and 125, you have 40% tax. Now over 125, you have 45% tax. Okay, so this is called a progressive tax system. That means that it's progressing. As your income level, the higher your income level is, the rate of tax that is levied on you is progressing. That's why it's called a progressive tax system. Okay, so that's one thing. The opposite of progressive tax system is a regressive tax system. Okay, the term is regressive. Okay, so the regressive tax system is, it's very rare to see a regressive tax system in any country, but theoretically we should be aware of the possibility, because it's the opposite of the progressive tax system. So everywhere, most countries have this kind of progressive tax. In China also, you have a progressive tax system. Okay, so the regressive is just the opposite of this. You just flip it around. If your rate, as you go up higher and higher levels of income, if this is 45 here and 40 here and 20 here, then that's a regressive tax system. Okay, theoretically you should know what the definition of a regressive tax system is, although in practice it's very difficult to see it anywhere. Okay, in any country. So progressive versus regressive. There is also another type of tax system which is called the flat tax. This, I think, is present in quite a few countries, and many people recommend this. Flat tax means don't have a progressive tax system, just have a flat tax, which means that everybody will pay, let's say, 15%. Okay, even whether you're here or here or here, or you're a billionaire, you still pay 15%. That's a flat tax. It can be 10%, it can be 15%, whatever. But the point is that the rate is not changing. That's why it's called a flat tax. It's not progressing. Okay, it's flat. So these are the three terms that you should be aware of: progressive tax system, regressive tax system, and flat tax system. So in the UK now, you already get to know how to utilize the tax tables. From the tax tables, you know the rates of tax. You don't need to remember the rates of tax. And let me just show you here about the dividend income. Okay, the dividend income is this is not mentioned properly here. The bands here should have been put over here as well. Okay, the band should have been put here as well. So what we really mean is that the ordinary rates apply to this band, this upper rate applies to this band, and this one becomes this one is referring to this band. Okay, here this band upper limit is infinity actually. So here it's actually, you can say 20/875, 40/3375, 45/3935 for dividend income. Dividend income is classified separately in the UK tax system. Okay, it's a separate category because the rates on dividend income are different. The tax rates on dividend income are different. And one of the things you can see is that here's an example of how you implement policy by using the tax system. See, they could have easily made the dividend rates the same as this, right? But they have made it more favorable. Can you see that? It's more favorable because they want to encourage equity investments, right? When do you get dividends? When you invest in equity shares, right? So you can see one of the structures. So this is one of the things you can look at, you should consider or understand when you look at a country's tax system. So already by studying just this little bit about the UK tax system, you can already see that in the UK tax system, they have a built-in policy. They are incorporating a policy of incentivizing equity investments. Can you see that? Because if you do equity investments, you will get dividend income, and they're taxing the dividend income lower than the normal income. Is this clear? Okay? So you have to understand that this is how countries use, because they could have easily made it the same rate or a higher rate. They made it a lower rate. That means we want you to do equity investments and get dividend income because you are going to get lower tax on the dividend income. So policy being implemented through the tax system. So that's a normative preference that the elected government has. Okay, so this is your thing. So this is what I was showing you, progressive versus regressive tax system. So let me just quickly move on. Okay, I think I've already mentioned to you earlier about stock quantity and flow quantity. Balance sheet items are stock quantities. Have I mentioned that earlier in the last semester? Have I taught you that? Yes? No? Yeah, I taught you, right? So we're not going to spend time on it now. These are important concepts, by the way. So just remember one thing, that while we are trying to get a good score for everybody, we also have to keep an eye on knowledge. We have to keep acquiring knowledge. We have to remember what we learn, and we have to be able to connect it to everything else we have learned and to what's happening in the real world. Because otherwise, later on when you go for your master's interviews or your job interviews, you're just a person who's sitting there with a degree around your neck, and I got a good score in the exam. But if you're not impressive in the interview, you will not get the job. You understand? So you have to make yourself an impressive candidate overall. Just the score is not good enough. So that's why knowledge is also important. We are going for good scores, but we also must have knowledge. So both goals have to be addressed. So these things are important from the point of view of conceptual clarity and knowing about these things. So these discussions are there. Okay. So let's quickly move through as much as we can. Okay, so we have different ones. So here you can see now, you see the answer to this. Okay. So these are examples. So these are your direct tax rates actually. If you see here, these are all your direct tax rates. These are your income tax rates. Dividend tax rate is also your direct tax rate because it depends on your level of income. The tax rate depends on your level of income. So these are your main direct taxes. Okay. The corporation tax is just income tax for companies essentially. They just call it corporation tax, but it's nothing but the income of the company, the net income, and on that you pay, actually your profit before tax, and then you pay tax on that. Your taxable income, you pay tax on that. Okay. So taxes administered by HMO, etc., etc. Indirect taxes are mainly it's value-added tax. Okay. which is one of our topics, VAT, or some people, you just call it VAT because it's shorter. So VAT is a sales tax. It's a sales tax. So here, this one is actually not a function of your level of income. So let's say if you have a 5% sales tax on iPhones, so whoever buys the iPhone has to pay 5% sales tax. So whether it's a billionaire buying an iPhone, his income is billions of dollars, he also pays 5%. And then the maybe just maybe a student who's not even earning anything, maybe just uses some pocket money or something to buy something, that person also pays 5%. So income level is quite low, but still the person is paying 5%, the sales tax. Okay, so that's one of the reasons why people say that you should remember this statement. People say that sales taxes are regressive. Okay, sales taxes are said to be regressive because even the poor people have to pay the same rate as the rich people, because it's a sales tax, right? It's a flat, it's a standard tax for everybody. It's not a function of your level of income. So because of that, people say that it's a regressive because it's not progressive, right? They don't make the billionaire pay a higher sales tax when he's buying an iPhone. They don't look at his level of income. So that's why they say it's regressive, because the person who's got a low level of income has to pay a standard sales tax, and for him it's a higher percentage of his income. So you're taking away more of his income in tax, so that's why it's said to be regressive. Okay, so in sales taxes are said to be regressive for that reason. Right. Okay, so we got these customs and value-added tax, and VAT basically is a sales tax. Okay. Okay, these we will not spend much time on. Sources of law we already did in the law module. You can read. So whatever I'm not spending time on, as I said, you still have to read it yourself, okay, for your own knowledge. But in the class we have limited time, so I have to spend time on the things that are important. Okay, so EU directives are basically, these are actually a part of statute law. These are just statute law coming out of the European Parliament, okay? So in Brussels you have the European Parliament, and so those guys come up with different laws, directives and regulations, etc. Those are essentially statute laws, like made by the Parliament of the EU, and so it's the same thing, basically. Okay, now you see here coming to, yeah. So you have something called the tax year. That's why you see this textbook that we have from Melville. Every year there's a new edition, because after the finance minister presents the finance bill in the parliament, the rates, many of the rates can change, and so based on that, some of the allowances will change. Okay, like the dividend allowance used to be like 1,000 and it's come down to 500. So these kind of changes happen, and then they come out with a new version of the textbook. Right, now here we come to the memorization part. Now here's my, so you have to remember this part here, okay? So what I'm doing is I've got two categories of memorization, okay? One is important, which is, that means you should do it because you're going to get exam questions on this, like 1 mark, 2 mark, those kind of questions. So slides, all these memorized slides means I've just given the slide number, okay? So slide 9, for instance. What is the information in slide 9? The tax year for individuals. Running from 6th of April to the 5th of April next year, you have to memorize, okay, this information. So I'm not going to even read out this information for the other types of slide. So that's the warning to you, that all the information here you have to memorize. Unless, okay, let me just put this here. Now some of the information I also may not remember whether it's in the tax tables. So I will just write this, unless in tax tables. Let me just write this qualifier, okay? Just check the tax table. If it's in the tax table, you don't have to memorize it. But if it's not in the tax table, then the information in the following slides is to be memorized. These slides, I said, okay, it's not really optional. You really still have to do it, but it's not so important. These are more important because I have to prioritize, because there's so much, you can't memorize so much stuff. So in that, I'm trying to prioritize a little bit. So these are more, do these first, and then if you have some time and memory left, if you still have some RAM left in your head, then you can memorize some of the others. So like I put in 15. So 15 is not important, but if you can do it, it's nice. Okay. So slide number 9, memorize. Slide number 10, memorize. See that? So I'm not even going to, whatever you have to memorize, that means it's just information, okay? That means that Chinese New Year is on the 17th. This is just information. There's no concept to explain. It's just information, okay? So, memorize. Okay, now just information on HMRC, you just read it yourself. I'm not going to spend time on it. It's not conceptual. Self-assessment. Yeah, self-assessment is a term, okay? So here there's one thing to explain, deducted at source versus PAY. Do I have anything here? Let me just put in one note here. And that is slide 12, okay? This is slide 12. So we have this term called, you can see that if the liability, your tax liability, the tax liability is a technical term, so amount that you have to pay, right? Or the amount that is not the amount that you have to pay, that's a different thing, that is tax payable, okay? So there is, tax liability is the total amount of tax to be paid. Now some of that may already have been paid, okay? So that is done by deduction at source, okay? So this is a technical term again. We have basically a term called TDS. TDS is tax deducted at source. So what that means is that wherever your income is originating from, okay? So let's say you're a contractor, maybe you're a catering person who's providing, some food for the Duffy convocation or something like that. Then Duffy is paying you for your services, but before paying, they will deduct some tax and pay you the net amount, and the tax that Duffy will give to the government separately, directly. So that's called tax deducted. That means whatever is the source of your income, at the source of your income itself, the tax is being deducted. So in the same like and so I'll give you an example of pay as you earn. PAYE, we'll just call it pay, or payee or something like that. So this is pay as you earn. Okay, this is also a type of TDS. That's what I'm explaining here. Okay, so actually here this is a type of TDS. Okay, so it should be actually here the language should have been such as PAYE, because if you write it like that, now here you have to be careful about your English writing also. Remember, you're going to be an accountant, so your understanding of the English language becomes very important. That's why all of you have to develop your written and spoken English skills. The communication skills become very important, especially in this age of AI. What is really important is actually how well you can communicate, okay, and how well you can deal with people. Those skills will still remain valuable. So you have to remember all these things. So constantly polish your English. So here this is actually not correct because cannot be collected entirely by deduction at source or via payee. Actually here it should be such as payee, because payee is a type of deduction at source. Okay, so if you write it like this, deduction at source or this, that indicates that these are two separate categories, mutually exclusive. Do you understand what I mean? You see sentence structure? Are you following? If you write it like this, it means that TDS and payee are two different things which are mutually exclusive. That's not true. Payee is actually a subset of TDS. It's one type of TDS. So it should be written as deduction at source such as payee. Okay, that's how it should be written. Just a little note on language, because that's also a skill you need to develop. Okay, very important skill actually, especially in this age. Right, now, so it's a type of tax deducted at source. So whatever is the source of your income, the tax is deducted at the source. Okay. Yeah, now you see examples given. This is going to be another memorized slide. 13. I'm just skipping over it because it's just information. You have to memorize it. 14, memorize. Okay, just information. Nothing to, no concept here. POA, you should remember this term, because in the exam we will just say POA and you have to remember what that is. Okay. Yeah, I put the 15 in the optional, not really optional, but less important. So it's a second priority in terms of memorization, because there'll be so much material to memorize. And some of the memorization slides are not just what I mentioned. Some of the other stuff also, as you see, as you work through the examples, I won't be able to put everything to be memorized over here in this list, because some of the other stuff you'll see obviously that you need to memorize because it's not in the tax tables. So most of the things we are learning, the techniques, all of those technically you have to, strictly speaking, you have to memorize, because you have to remember how to do them. So I'm just trying to help you out here by highlighting certain specific slides which we obviously know you have to memorize, because in the exam you'll get questions for like 1 mark, 2 mark on these kind of things, and on different topics as well. Okay. So if basically here, if you have income, the idea here is that normally if all your income has been subjected to TDS, that is tax deducted at source, if all your income has been taxed in that manner, then you don't have to file this notification of chargeable income, because you have no other income which has not yet already been taxed. That's the idea here. That basically, if you have any other type of income, then you have to notify, because the tax authorities need to know that there is income that is that should be subjected to tax. So just to go back to pay as you earn, what is pay as you earn? Just to explain that, because you will get that kind of thing in your questions. Okay, so let me explain that. Pay as you earn basically is done by the employers. Okay, so for instance, like if I'm as an employee of, I'm here as an employee of Duffy. So when Duffy is paying my salary, they are already deducting the tax from my salary and paying it separately to the government, right? So that's an example of pay as you earn. So that's an example of one type of tax deducted at source. So that's mainly for payee is mainly for employees. Okay, so that's the term that we use for employees. Now you will see certain types of questions that will mention, so watch out for this. The question will mention that this guy earned a salary of £60,000. This guy earned a salary of £60,000 after deduction of payee. Okay, after deduction of £18,000 as payee. In that case, you have to remember, so they'll say 60,000 he was given net after deduction of payee. That means that for the purposes of writing down his salary, so 60,000 is the net salary paid to him after deduction of pay. This language will be like this: after deduction of payee. That means that the gross salary includes the payee amount. So if it's 60,000 and 18,000 payee, that means when you write the salary, you have to write it as 78,000. And then put the charge, calculate the tax liability. But finally, when you come to the tax liability, there is a difference between the tax liability and the tax payable, which we will show you. If certain amount has already been deducted, which is going towards your tax liability, then you don't have to pay that anymore. So they will deduct that from the amount you have to pay, the amount to be further paid. Keeping records, another memorize. Okay, record keeping. Okay, this is connected to, so in most countries' tax codes, there will be a system where, I think I can maximize this actually. Yeah. So in most countries' tax systems, there will be some kind of a limitation on this, that you don't have to keep the records beyond 5 years or 6 years or something like that. When you study VAT, you will also see that that kind of rule, that you have to keep the records. So you have to keep your business records. The idea here is there is something called in the common law systems, there's something called a law of limitation. Law of limitation means that there is a deadline by which you have to bring legal action. If you feel that some of your rights have been infringed, right, you need to bring legal action within a certain deadline. You can't just wait and wake up after 35 years and then bring a legal action saying that, oh, that guy defrauded me on a contract 35 years ago. So the system does not accept that. They want to put a limit on litigation. So there'll be most of the countries it's about 6 years, or you can check the rules in the different in particular countries. But there's something called a law of limitation, beyond which you can't bring legal action for some kind of infringement of right. So you still have the right, but you can't bring the legal action. You lose what we call the remedy. You don't have the remedy. You have the right, but you don't have the remedy. So there is a law of limitation. So record keeping is connected to that. Okay, you just need to keep records for like 5 years. So after 5 years, the tax authorities cannot sue you for any tax due. So if they find there's 15 years ago you paid less tax, it's too bad. They should have come with the action within 5 years. So this is also law of limitation being applied to the tax authorities. So if it's some kind of tax discrepancy, maybe 15 years ago, they suddenly wake up and they find that you should have paid this tax, that's too bad. They can't take it from you anymore. They can't even bring the legal action to take that tax. So that's why your record keeping is actually limited to a certain number of years, because beyond that, the tax authorities cannot ask you for further explanations. But you need to memorize this, because they will ask you some of the questions. They'll be like 1 mark, 2 marks. How many years does he need to keep the records? That's okay. The tax authorities can conduct investigations, as we know. You can appeal against that. This you don't have to, I don't think you have to memorize all this 30-day stuff. Okay, here's another concept, okay? Tax evasion versus tax avoidance. Which one is legal? Do you know? Tax avoidance, okay? So tax avoidance is legal. So this concept is important because it's actually a big part of your topic number 2. And most of the time you will get a question, so we should prepare a standard material. I'll give you some guidance on that. You should prepare some standard material on this topic. Okay, so tax evasion versus tax avoidance, and the ethics of taxation. You'll hear some you see in the media there's always talk about companies are not paying their fair share of tax and those kind of statements. And so those are actually really a criticism of tax avoidance. But tax avoidance, so let's get the concepts clear first. Tax evasion is illegal. Let me see where I got section 19. Yeah. So it's an important concept because we have a topic on this basically now. So tax evasion is illegal. Tax evasion means that if I'm earning certain income and I don't disclose the income to the tax authorities, that is tax evasion, okay? Or I underdeclare my income. So if I'm running a restaurant, maybe I have some cash sales. I don't disclose the cash sales, okay? So those kind of things where you underdeclare your income or you just conceal certain types of income, those kind of things are called tax evasion. That's illegal. Okay, you are supposed to declare all your income. Okay, but there is something called tax avoidance. Okay, which is also coming under attack. But so far, still, most countries maintain that tax avoidance is legal. Okay, so when people say things like they're not paying their fair share of tax, they're actually attacking even the legality of tax avoidance. So this is a kind of a critique that many of these NGOs and all these activist groups are coming up with. But that's an attack on tax avoidance. So tax avoidance is legal. There's this important statement here that taxpayers can organize their affairs to minimize your tax. If you follow the rules and you take advantage of the tax rules, like for instance here, you can see that here, you see how dividends have dividends have lower rates of tax. So maybe you do a lot of equity investments and you try to get a lot of your income through dividends. Later on, you'll see there are lots of allowances given for investing in certain types of schemes. So maybe you make a lot of investments in those kind of schemes. Then there are some tax deductions available for certain types of contributions. So maybe you make those contributions. So you are just following the law. You're just taking advantage of all the loopholes or whatever provisions are given by the law to minimize your tax liability. That's perfectly legal. Okay, and that thing has a name. Okay, it's not mentioned over here, but it's a very important concept. So as accounting students, you should know about it. That's why I added that information in your notes. And this concept that you can actually do proper tax planning, this is called tax planning. Okay, when you study the tax laws and try to find out, okay, how can I legally, without breaking any law, how can I minimize my tax liability? Okay, this is called tax planning. So, and this point, so this is, as I said, you can organize your financial affairs to minimize the tax burden. Let's see here now, here. Okay, this thing is called the Westminster Principle or the Westminster Doctrine. Okay, this concept, because it's based on a famous case, and as you can see, it's actually a tax law case. It's a famous tax law case, and this is why I keep telling you that you're not just studying accounting, you're studying accounting, finance, economics, and law, all put together. These are not separate subjects. They are all actually the same. In the real world, all the problems will come in a form where these subjects are not different. They're all integrated. So you need to be aware of these terms. And so as far as possible, you can see this appears in an accounting lexicon. For some reason it's not here. You see the Westminster Doctrine. So it's appearing in an accounting lexicon, but it's actually a famous tax case. Okay, so it's from the law. That's why I say accounting and law are very closely connected. Okay, so Westminster Doctrine is that here. You see this? So you should know that it's called the Westminster Doctrine or the Westminster Principle. It's a famous case. It comes from this famous case in 1936. So Commissioners of Inland Revenue versus the Duke of Westminster. These are the tax authorities. These are the tax people. And they sued the Duke of Westminster for an arrangement. And they said that the Duke owes income tax on this. Okay? But the court said no, he doesn't owe income tax on this. It's a perfectly legitimate thing, whatever he did. He tried to minimize his tax, but he did not break the law, so it's perfectly legal. So the court ruled in favor of the Duke of Westminster. So this case is, and this principle is called the Westminster Principle or Doctrine. So you can see so much material here, and in an accounting lexicon. So that shows you why I say that these are all connected. Tax law, accounting, everything together. Okay, all right. So I got the links here. There's another link here as well. So in your spare time, during the holidays, during the summer holidays, here semester is so tight you don't have time to do all this. But during the summer holidays, you should read all these documents, which I'm linking to. They're all available in China. Now, another one, slide 20. Yeah, anti-abuse rules, some additional information, so you should know about this term. This is a tax term, actually, GAR. So we just call it GAR in tax law. Very interesting. So another thing I would say is, if you are interested, you should dig around a little bit, because once you become an accountant and you are working, you have to figure out which area of accountancy you want to practice in. So one of the interesting areas of practice is tax law. It's very interesting. So you could think about, maybe you should try out tax law and see. Lots of interesting concepts. You can specialize even in international tax, all those kinds of, so taxation of international transactions, okay? Even in China, we know that there are many rulings that come out from the tax courts on international tax cases. So if you so these are all the areas in which you can specialize. Okay, so tax is one area. So general anti-abuse rule, we should know about this. So these are basically, this is what is happening is in all these arrangements like systems like GARD and all, the tax authorities are trying to attack tax avoidance. They are basically what all this means is that in most countries they have this now, because the government doesn't even like the fact that you are doing tax avoidance, even though what you're doing is perfectly legal. So they are trying to even within tax avoidance, they are trying to cut down your freedom. They're saying, okay, you can't do this, you can't be so clever in your tax avoidance. So we are just trying to cut down whatever tax avoidance you can do. So this is just an attack on tax avoidance, but you should know about this. It's called GAR, which means the General Anti-Abuse Rules. So in most countries you'll have this. Okay, now I mentioned this in slide 20. I've mentioned this, all this stuff, not in your syllabus, but very interesting. Once again, I think you should read it when you're in your summer holidays. These are all the fancy, and some of it is actually relevant for your discussion, because this will come up in topic 2. It's actually, I wouldn't say it's out of the syllabus. It's in your syllabus, because you will see that, like this one, okay, let's open it. It is actually relevant for you, because in topic 2 we are dealing exactly with this. So you should understand a little bit about what's going on here. Okay, here, so what happened was, see, Ireland has a very liberal tax system. Okay, in that sense, it's like Singapore, Hong Kong, etc. Hong Kong, as you know, is a separate jurisdiction, although it's not a country, but it's a jurisdiction. They have their own tax system. So the tax system in Hong Kong is different from mainland China. Okay, although it's part of the same country, but it's a different tax system. So they have very low taxes. They are always competing with Singapore. And Ireland is a European company, European country which has a very liberal tax system. They have, I think, like 10% or 11% tax or 15%, something like that. So these are kind of tax techniques used by, tax avoidance techniques. So that's why I mentioned it here. So it's not really outside your syllabus, because your entire topic 2 is going to be on this. Topic 2 is on this topic of the ethics of taxation. So basically what you have to understand is what is happening is, see, on the one hand, there is tax evasion, which is totally illegal, okay? If you do it, you get caught, then you go to jail in most countries, okay? Or you pay a hefty fine. But then there's tax avoidance, which according to the Westminster Principle in 1936 was made legal and is still holding up. But as I told you, the governments don't like the fact that you're doing tax avoidance. So they're constantly trying to cut down even your freedom to do tax avoidance is being attacked all the time. So all this GAR and all is an attack on tax avoidance. Similarly, what is going to happen is all this fancy tax planning done by tax avoidance actually. So all these techniques like double Irish switch, Dutch sandwich, this is referring to the tax law in the Netherlands and in Ireland, because Ireland has a very low tax regime, okay? So what happened in Ireland is that several years ago, they went to a very low tax regime, as I said, 11% or 15% or something. And so as a result of that, you will find that most of the US multinationals who operate in Europe, like Starbucks, Apple, Google, Facebook, all these companies, all of them will have their Microsoft, all of these, Amazon will have their European headquarters, and the EU is a pretty big economic area, right? It's a very big economic area, the EU, 28 countries or 27 countries. Okay, we have a 5-minute break. Okay, so I was mentioning about this GAR. So what you have to understand is how the whole, your whole topic 2, or one of the main elements of topic 2 is this whole discussion about tax and ethics. Now, where is the question of ethics coming up? It's basically because they are trying to attack tax avoidance. So we had a very clear demarcation earlier that, and as you can see, it was clarified by the, where is our, here, okay? So it was clarified in the Westminster case, right? That this is one, and this is, so in 1936 you had the Westminster ruling, which very clearly laid out the 2 categories: tax evasion, illegal, and tax avoidance is legal. But the government is not happy, and many of these activist groups like the NGOs and all, they're not happy. So they want to keep on pressing people, and they're trying to cut down your freedom to even do tax avoidance. So what is happening here is things like GAR are an attack on tax avoidance. It's an attack on trying to reduce your freedom to do tax avoidance. And there are other initiatives like BEPS. You might have heard of BEPS. It's a G20 initiative which is trying to reduce companies' ability to do tax planning, essentially, right? They all have minimum tax rates. Have you guys heard about BEPS? Have you heard of something called BEPS? You shouldn't spend so much time on it. And it's not really out of the syllabus. It's a very topical point. Have you heard about BEPS? BEPS, now that means that BEPS, then BEPS leads to Pillar 1, Pillar 2, Pillar 1 and 2. Have you heard about these things? You should hear about these things, because this is what I mean by being anchored in the real world. As an accountant, as an accounting student, you should have heard about these things. These are all initiatives that are coming. BEPS, you can go and search for what is the full form. It stands for Base Erosion and Profit Shifting. BEPS, Base Erosion and Profit Shifting. That means base erosion means the tax base. The government wants to tax as much income as possible. The government doesn't like the fact that you are doing tax evasion and you are doing tax avoidance and reducing your taxable income. The government doesn't like it. That's why they have GAR and all these things. And then BEPS is also a part of that. So governments all around the world, they all gang up together, and they don't like the fact that companies are doing tax planning or tax avoidance. So they are coming up with various rules. Now you have this BEPS initiatives from the G20. It's a G20 initiative. And so you should inquire about this. You should know about what is happening. Okay? If you look at famous accounting podcasts or websites, you'll see a lot of discussion about Pillar 1, Pillar 2. When you become an accountant, you'll be dealing with all these things. So you have to make sure that you go beyond, do some research on your own, right? Nowadays you have AI. You can just ask DeepSeek what is all this stuff. Just go and ask when you have some time. Maybe now, not now, because you have to really focus. But this is important for your topic 2 as well, because this whole of topic 2 is on the discussion between tax avoidance and tax evasion. And this topic is called ethics and tax, okay? Or tax and ethics. And the whole idea of ethics is basically nothing but an attack on tax avoidance. You have to understand it. Tax and ethics, when they say tax and ethics, they are basically using this whole idea of ethics and morality and all that to attack tax avoidance. So that's where you'll see what is going to happen. It's all very important, actually, part of your topic 2. See, all these schemes, when you do if you do a search on, ask DeepSeek to tell you about all these things, okay? And read the article first, and then give an intelligent prompt to the AI. It'll give you more information. and this goes directly into your topic 2, because in topic 2 you will be actually required to talk about some specific cases which are given in your slides as well, but you can add more material. Specific cases of tax planning by famous US corporations like Amazon, Google, Starbucks, to reduce their tax liability. What have these guys done? So this is one example of what these guys have done. This kind of a scheme, double Irish with a Dutch sandwich. That means they're using subsidiaries in the Netherlands, in Ireland, okay, to basically arrange their incomes and expenses in such a way that their tax liability is being minimized. So it's tax avoidance. It's all legal, but it's being attacked by ethics. They're saying it's legal, but it's not ethical. You understand? You understand the attack? So tax avoidance is legal, but the government is attacking it by using things like GAR and BEPS and all these things. And all these NGOs and activist groups are attacking your tax avoidance by saying, it's all legal, but is it ethical? Shouldn't you be paying more tax? Okay, so that kind of argument. So this is the discussion which you have to capture in your answers on topic 2. And you should prepare a standard answer on topic 2 with material that you should have ready-made. And then depending on how the question comes, you will tilt the answer. But you should have the material ready-made and you can use it. Okay, this is clear. So that's why these are not really out of your syllabus. All of these, no, how did I remove the BEPS? It's a G20 initiative. Okay, base erosion and profit shifting. Okay, so these are all examples, and that includes pillar 1 and pillar 2. So, and this is basically, so all this is on this whole idea of 19 and 20 is whole idea of tax avoidance, tax evasion, and coming to your idea of using ethics to attack tax avoidance. Okay, let's try to move on from here and get to, okay, making tax digital, we don't have to worry about. Yeah, you can just read all this stuff, okay? Just read all this stuff for yourself. Yeah, this is about the procedural aspects of GAR, that if the HMRC attacks, HMRC is His Majesty's Revenue and Customs. We just say HMRC. So I say His Majesty's because right now Charles is the king, so it's a male king. But when his mother was the queen, it would have been called Her Majesty's Revenue and Customs. So H is either his or her, depending on whether you have a male or female monarch, okay? In the UK. This is all basically, we're mainly focused on England. So, yeah, so HMRC is the tax authority. And these are the procedural aspects of GAR, which I don't think are that important. Okay, making tax, you just read on this. Yeah, I don't think we need to worry about these dates, and that's why I've not added that. I haven't added that to your, yeah, I didn't add 21 to the memorization list. Okay, now let's look at introduction to taxable income. Okay. Who is taxable? Resident in the UK. So we make a distinction between resident and non-resident. Okay, so I don't think we have to worry too much about residency, but in the module itself. But as a concept, you should understand that residency is a very important concept in taxation. Okay, so that's something to be aware of. What makes you resident? In most countries, there's a general rule that you can find, and that is that if you stay more than 6 months in the country, then you become a resident, a tax resident of that country. Okay, so you don't have to be a citizen to be a resident. Okay, so I am an example of a person who is not a Chinese citizen, but I am a Chinese tax resident because I spend more than 6 months of the year inside China, right? So I am a tax resident. I'm tax resident in China. So, yeah. So your tax levy is usually, the tax law is arranged in such a way that residents and non-residents pay different rates of tax, and different types of income are also taxable. As you can see here, that in the UK, if you are a resident in the UK, you have to pay tax on your global income. So maybe you have a house in Hong Kong and you have some rental income on that house, but you are living in the UK. Well, you have to declare that Hong Kong rental income to the UK tax authorities and pay tax on it. Okay, so that is the system that the UK has, and I think the US also has it for citizens. I'm not sure they have it for non-citizens, but in China you don't have that. So in China you pay tax on only whatever you earn locally. Okay, you don't have to pay tax on your global income. At least the non-citizens don't have to. So these things have an implication. I mean, there's an implication depending on your status as resident, non-resident, etc. And now various types of income. You can see this. You'll see this in the pro formas as well. Yeah, as you saw already, that dividends, each type of income has different rules. You already saw that the dividend tax rates are different, right? The dividend tax rates are more favorable than ordinary income. So like employment income, if you get employment income, you'll be paying that 20% and 40% and 45%. But if you have dividend income, then the rates are lower. Okay, now here there's a point to note. So this you should remember. That here, now this is again, you'll notice that I've given that as a memorize here. So it's good to memorize this, because what kind of income is exempt? Exempt income means it is not subject to tax. So we make a distinction between exempt income and income that is taxed at zero rates. Okay, so based on certain types of allowances, etc. I don't know if I've made this mention here at this point. Yeah. So I don't know if this is big enough, the font is big enough or not. Yeah, okay. So we have to make a distinction between, this is zero. Zero means 0%. This distinction will become important even in VAT, when we do VAT later on, that there are certain things called exempt supplies which are not subject to VAT at all. And then there are certain types of supplies which are called zero rated supplies, which means they are subject to VAT, but right now they have their tax rate is 0%. So there is an important distinction here. The first one is not even tax, it's not subject to tax. The second one is subject to tax, but it's just that it is taxed on right now at 0%. So these two are not the same. Just because something is taxed at 0% doesn't mean that it is exempt income. Okay, so for instance, you'll find that there are allowances that we will do. Those are subject to 0% tax, but they are not exempt income. Okay, now here we come to, let's go to, so you have to memorize this, okay? Here again, you can see the different policy elements, what they're trying to do, what they're trying to encourage. So this is how they give you, they try to shape the policy. Whatever they want you to do, they give you, like, they're making that kind of income exempt. Okay. So now we are getting to the income tax pro formas. These are known as the pro formas, okay? So you'll have different types of income. There's different types of income. You have a total income, which is you can call it a gross income, and then you'll have a net income. So after tax reliefs, any kind of tax relief given, okay, that after deducting that you get your net income. So this we will just call NI. So NI will be different from ANI. ANI is adjusted net income. So we will use a lot of these acronyms. Then personal allowance is called PA, personal allowance. So you have to remember these structures, which is, now here I've not given it as memorized, but it will become obvious because in the calculations you will have to see, you will see that you need to know about these terms. Okay, so because now pretty much everything, so everything that needs to be memorized is not going to be in that list. As far as possible, I'll try to put it in that list. So please don't read this as, it's not an exhaustive list. okay? Let me make it clear, okay, that this is not an exhaustive list. Yeah, so what does that mean? The list here we have given. These you definitely have to memorize, but there are many other things you have to memorize. It's not possible for me to list everything. That's why this is not exhaustive. This list is not exhaustive means that the total number of things to be memorized is many, many more things actually. Is much larger or higher. Okay, so you can see tax into gross income, you can call it gross income less tax relief, net income, less PA is taxable income or TI. Okay, now let's look at it. Again, this is continued from the previous, so I should actually put it like this. Try to make it, if we can see together. Yeah, well, it's not very, you can't see. I wanted to put everything in one view. Maybe I can make it a little bigger, and maybe I can have, oh no, it doesn't work like that actually. I have to have everything like this, I think. I won't have the typical, yeah, see, business profits, okay. Now I need one more actually, yeah. Yeah, that's how you have it, okay? So you have all your gross income, less the tax relief gives you NI, then less the PA gives you TI. I know the font is small, but I think on those screens, are the people at the back able to see what I'm projecting here? Does it go there as well? On those computer screens? Is that the same thing? Yeah? Okay, so at least you can see something from there. Okay, but so anyway, so you can see this becomes PA, that becomes TI, okay? After PA it becomes TI. Okay, now, so then you have TI. What is the point of TI? The point of TI is that the tax will be levied on the TI, on the taxable income, okay? So when people are doing all these tax avoidance schemes, what are they actually targeting? They are targeting to reduce this TI. They want to reduce, the goal of all the tax avoidance is to reduce the TI because the tax will be levied on the TI. Okay, so then first you see, this is now, you can't read it, but it's basically the three bands, okay? The BRT is, these are, this red ones which you can't read probably, are basically this, okay? The red ones are basically this. Yeah, where is it? Yeah, this one, okay? So the red ones are really referring to the 20% over here, okay, 0 to 37. Then the 40% from 37 to 38 to 125. And then the 45% above that, okay? That's all it's referring to. Where is, I thought I had something somewhere here on the three bands. Yeah, okay, so these are the two thresholds, okay. So here I have made, so this is basically what it is, okay? Right, you can see the thing. Now what happens is, you levy the different taxes, so whatever income you have, you levy 20% on the first slab. Okay, now these are called slabs, okay? So if you look at, where is the, I had this done yesterday, somewhere in the, yeah. Okay, so let's call these the slabs, okay? So here you have the S is for slab, okay, SLAB, slab. This is called a slab. Slab is like a strip, okay? So this is your BRT slab, which is the basic rate tax slab. So in a slab, you need two levels, you need two numbers. It's a range, so you need two numbers in a slab, okay? And and I've also defined something called a threshold, which is either you can just call it BRT, or it's better to actually call it BRTT, okay? Which is, so we make a distinction between a slab and a threshold. I don't know if I put it into the slides. Sequence of applying slab and threshold. Okay, so I may not put this thing. It's not really a thing, but let's say call it slab versus threshold, or upper limit. Okay. I put it down somewhere. I don't know where it is now. I put it down. I remember writing it in the, let me see here. Yeah, okay, there it is. Okay, so I have it actually. Yeah, so I have put it against, oh yeah, okay, so I put it further down against slide 28. Okay, various sources, less tax relief, NI less PA, I already put that. Okay, so I'm just calling it the BRT stands for the basic rate tax, 20%. Okay, so this is the BRT tax slab, 0 to 38. Okay, we're just using these terms slab and threshold. So I don't need to have this here. The slab has upper and lower bound. Maybe I should have it here. Okay. And as you can see, the threshold has only one upper limit. The threshold refers only to the upper limit. So these are just terms that we may use. So the slab has two numbers to define it. And in the case of the ART slab, okay, this is the 45%. The upper limit is actually infinity. But since infinity is defined, so we can take it as a valid number. So yeah, so so 45% is the ART. So ART stands for additional rate of tax, 45%. So this is the ART slab, okay? And this is the BRT threshold, basic rate tax. So in the slides you see they're referred to it as simply BRT, okay, basic rate threshold. But I've just called it BRTT. Doesn't really matter, you can use either point. The main thing is to understand that the threshold has only one number, the upper limit, and the slab is the two numbers combined, defining a range. The slab is always a range. Okay, so you got that. So all we are doing is we are taking the 20% on the first slab, 40% on the second slab, and 45% on the next slab. Now here we come to, this is your tax, this we can call your gross tax liability. Okay, taxable income. After that you apply the taxes, and then you get your gross tax liability, and after that you have your tax reducers. Now here we need to get to a concept here, so I'll explain that. Yeah, in the UK, have you heard this term called a tax credit? Have you heard of something called a tax credit and the distinction between tax credit and tax deduction? No? Okay. So this is an important conceptual discussion, so we will get into it. Okay, so now you have to understand the tax credit versus tax deduction. Here, let's look at the calculation once again. So first let me give you the definition in words, and then we will look at the numbers again. Okay, so a tax credit, so in the UK they have this term called tax reducer, which is even more precise actually. But most of the countries, they don't use this term. The term that is internationally used is the tax credit. So if you say tax credit anywhere in the world, people will understand what you mean. But in the UK, the term for tax credit is tax reducer. And that itself tells you what a tax credit does. It reduces your tax. So a tax credit reduces the tax liability after the tax liability is calculated by applying rates of calculated, we can put this in brackets, okay? By applying tax rates to taxable income. Okay, how do you calculate taxable tax liability or gross tax liability? Is by applying the tax rates to taxable income. Okay, which is what you see here. See, what are you doing? Taxable income, then you're applying the tax rates 20%, 40%, 45% to your taxable income. That's how you arrive at the tax liability, okay? Now, you can call it a gross tax liability. After that, you apply the tax reducers, all right? So what do the tax reducers do? They reduce the tax liability after it is calculated. So it is the later stage of the calculation. And tax rates should apply. I think this is redundant. I don't need this actually. It's creating confusion, unnecessary text. Yeah, it's not required, okay? Now, what is a tax deduction? Tax deduction is allowed to reduce your total income in the process of calculating the taxable income. Okay, it's an earlier stage of the calculation. So if you look at a tax deduction, like this is an example of a tax deduction. See, the tax reliefs. We don't know about the specific reliefs here, but there can be various types of tax reliefs given. Those are all tax deductions. So what is the purpose of a tax deduction? The main point is that the tax deduction is happening before the taxable income is calculated. Do you understand? That's the main distinction. When you think about tax credit versus tax deduction, you should see it as the key point is the taxable income, the calculation of taxable income. The tax deduction is applied before the calculation of taxable income. It is a deduction given to you in order to reduce your taxable income. This is clear. And the tax reducer or the tax credit is applied after so this is an example of a tax deduction, tax relief. PA is an example of a tax deduction because PA allows you to reduce your taxable income. Yeah? But this is an example of a tax reducer because it is reducing your gross tax liability or tax liability after the taxable income and calculation and the tax liability, gross tax liability calculation on the taxable income. Is this clear? So the key point is this: the taxable income is like the dividing line. The tax deduction comes before taxable income is calculated, and the tax reducer comes after taxable income and gross tax liability on the taxable income. Then you apply the tax reducer. So the tax reducer just reduces your tax liability. Your calculated tax liability is reduced by the tax reducer. Is this clear? Yeah? Okay. So that's what I've given here, the distinction. But it's important to understand this concept and to understand that where is that later stage versus earlier stage versus later stage of the calculation. Okay. What else are we looking at here? Here I have these things: gross incomes, various sources, less tax reliefs. The PSA is not again, so we'll come to this later. When we get to the PSA, we'll come to that later. I think this is on a different slide actually. It should not be over here. Let me at least put it down further down because it's which slide are we on now? This is 28, 29. Okay, so we'll just skip this. This is coming later. Income tax on savings income. So it is on 33, but okay. This I have 27, 28. So I have actually 28 before I come to 29. So this actually I should do earlier. So I should move this whole discussion here so that it appears in sequence. So I should move these notes for slide 29, 28, 29. Yeah, tax deduction, tax liability, minus taxes, that's cool. This is actually, yeah, on slide 28, 29, example I don't remember what Ursula's like, but let's leave it here. Okay, let's go here and put it after 27, so that, yeah, so that the description appears in the proper sequence. Yeah, okay, now that makes sense. So we already explained this. Right, now you see this. Yeah, going back to this, so let's go back to the 28, 29. Here, you see this whole important thing. These are tax deductions. This is a tax reducer or tax credit. So after that, there's one more concept to go through here, important concept to watch out for. So when you're doing calculations, these are all important things. So, I mean, to give you an example of what I mean by that's not that thing which I put in the top of at the top of your notes. It's not an exhaustive list of things to be memorized, because these things also have to be memorized, but they're not listed over there because it's not possible for me to list everything. So you need to know what is net income, what is gross income. After that, how do you get to net income? You need to know that, so memorize. Okay. PA, how do you get from NI to TI? You take out PA, that also you need to know. Then you apply the tax rates on the different slabs. You apply the tax rates on the TI, and you come to the gross tax liability. Then you apply any tax reducers that are applicable. You have to find out from the circumstances if there are any tax reducers available in this situation. Okay? Then you deduct that, you get the next, you can call it the tax borne or the net tax liability. Okay? This is from gross to net after the deduction of the reducers. You can call it tax borne, or it's like the net tax liability. Now, net tax liability also does not mean you have to pay that, because you have to then consider, has there been any tax which has already been deducted at source? So you have to remember that. So there is a distinction between the net tax liability and the tax payable. This is important. Do you understand? Because your net tax liability might be 100, but maybe 45 has already been deducted at source. So 45 of tax has already been deducted at source. Your net tax liability is 100. So now your tax payable is only 55. Do you understand? So there is a difference between the net tax liability of 100 and a 45 which has already been deducted at source. So that's why after finding out the net tax liability or the tax borne, you have to find out then, has there been any tax deducted at source? Then you have to reduce that number to arrive at the tax payable, because if your net tax liability is 100 and 45 has already been deducted at source by, say, payee or something like that, then you have to, your tax payable is only 55, not 100. Is this clear? So there is a difference between the net tax liability and the tax payable. Okay, so these are all important concepts. Okay, so you see in 28, 29, all these are important. So if I highlight here 28, 29, okay, so you have TI, you have gross income TI, then you have tax payable, then you have net tax liability, tax payable, reducers, etc. All these things I discussed here, these are all important. Okay. Right, now let's go to this. Now we can increase the size focus. We can increase this font size. Okay, now married couples. Now this is something to remember, that because you will get some exam questions on this. That is, that married couples are tax and civil partners. So in the UK you have a system of what is called a civil partnership, which is like they are not really married in the official sense, but they are living together and they are wishing to be treated as a civil partnership. So these are all taxed independently. So if you get a husband and wife, sometimes you'll get a question which is talking about the wife's income. Maybe the wife is running a business, and then they will also mention that her husband was earning this much. So that's meant to be a trick to confuse you, so you don't mix the husband's income with the wife's. the husband and wife have to be taxed separately. So you have to come up with two separate taxation calculations for the husband and the wife. Okay, so this is already apparent. You already saw the tax tables. You know the rates of income tax. Okay, 20, 40, and 45. Okay, now you have different categories of income: non-savings income, savings income, and dividends. So in our pro forma, if we look at the pro forma now, we start looking at the pro forma. Yeah, this is pro formas are also in your folder. Please remember. Okay. If you go to, this is your capital gains tax question bank. Okay, that's in your question banks. But if you see here, there is a folder called Proformas, right? This is where you'll find the kind of stuff I'm showing you here. If you click that folder, you'll find this here. So this is the format. Now, when we say you get marks for use of Excel and formatting, please make sure you follow these kind of formats, okay? The way that you have to present, you can't just make up your own format. You have to follow the standard format. So that's what you'll get marks for. That's why I said that. Actually, it's very easy for you to pick up 5 to 6 marks on the assignments. If you just make the submission and take a little time to use Excel properly, have good formatting, use formulae. Again, somebody has opened it. You should not be opening it. It's a distraction in the class. In the class only, I will open it. You open it at home later on when you're studying. Okay? So various types of the various topics that we have. But here, what we see is, this is how we are going to classify the different types. So we are talking about this slide, okay, which is 31, which is that we have, these are different types of income, okay? Non-savings income, savings income, and dividends. And in NSI, we'll just call it NSI, has employment, business profits, and property. So you can see this under NSI. Now this has to be your format, okay? So why did they put dividends separately? Because you know there is a separate rates of tax for dividend, right? So we have to keep it separate. So NSI, you have employment income, property, and bank interest and things like that. Dividends. Dividends go into this one, okay? Bank interest goes into savings income. So employment income, property income, and business profits will also go in here, okay? We can add business profits here as well. Okay, so we can say we'll just add it here. Okay, this has to be a format, and you start applying the rates. Okay, now before we come to 32, 33 income tax. Okay, so before we come to this is actually slate 30. Let me already start to explain this pro forma and how the calculation is done. Again, somebody has opened it. Don't open this sheet in the class. It's very distracting. Okay, because I don't want to see as I'm pointing out different things. Now see, let's see how we're going to do a calculation, an example of how we're going to do a calculation. Okay, so we have very little time left, but I will just show you, try to cover one thing, which is, let's go here and let's try to use this format. Okay, so NSIs, SI, and DI. Okay, and so the way we do it normally is that we will have these 3 slabs, right? We have these 3 slabs, so it's like we are now going to start. First, we will start with, what you have to remember is that first NSI, these are all things to be, NSI has to be taxed first. That's why it's put over here. NSI must be taxed first. Then you tax, of course, if you don't have NSI, then if you have only SI, then you have only SI, then fine. But if you have all 3 types of income, then the sequence of taxing is, this is where I've tried to deal with this here, that the sequence, this is slide 33 is talking about the sequence of, well, this is related to that actually, not exactly, but it's related to that. Different rates. It's actually all 31, 32, 33. The sequence of applying rates to tax rates to type of income. NSI, first NSI, then SI, then DI. Okay. So how are we going to apply it? Let's take an example of a guy who has, let's say, I'm just dealing in thousands. Okay. So let's say this guy has 45K of NSI. So put the numbers in thousands. He has 45K of NSI. He has 7K of SI, and he has, say, well, initially we will consider a slightly lower DI, because what will happen is there is something called a savings allowance, okay, personal savings allowance, which is the PSA. Okay, so let's make a lower dividend income first. Let's make it yeah, so that gives you 55K. So let's say his NSI is 45K, his SI is 7K, savings income, and his dividend income is 3K. All right. Now, what happens is that there is another calculation that has to be done, which you will see here further down. Savings income, PSA, personal savings allowance. So there are rules for that. We will get into that later. Those are covered in slide 32 and 33 actually. There you see the rules for savings income. But basically the rule is such that you have, if you, so this is the calculation I've done for figuring out how much is the personal savings allowance. So it's pretty simple. Maybe I overcomplicated it by creating a spreadsheet. But if your income is 55K, so the rule is basically that this, I can already show you this actually, that there is a savings allowance. Yeah, it's actually referring to slide 34. Okay, so this slide 34 is talking about the, I should put this here, okay. So let's say it's slide 34. This one is dealing with slide 34, okay. So all this 31, 32, 34, all are connected actually. So there is a rule for personal savings allowance, which is for your savings allowance means it will get taxed at 0%. So whenever you have an allowance, that usually gets taxed at 0%. So it's not exempt income, like I said earlier, but it is actually income taxed at 0 rates. Okay, so that's what is the meaning of an allowance. So there is a savings allowance. If your taxable income is over this, the PSA becomes 500. If your TI is below this, then the PSA is 1,000. And if it is above 125, then the PSA is nil. Okay, so I just put this into a formula here, is overcomplicating it. So if your income is 55K, then your PSA is 500. The way I use this is here, it's a blue cell is in. If your income is, let's say, your TI is 25, you see that the PSA becomes 1,000 because your TI is less than 38. Okay, so less than 38, so it is 25, full 1,000 is available. In this case, this guy has made 55, right? So how you tax it is you tax 45 at 20%, okay? You tax 45 at 20%, then you have 7, no, so now you can't tax 45 at 20%, right? Because you can only tax 37.7, you can only tax this much at 20%. So what happens is, your tax, if you look at this guy's tax, what is his tax? Here. So he pays 20% on, how much tax is he going to pay on 45 of NSI? He can pay 20% on the 37.7, okay? But on the balance of 37.7 up to 45, he has to pay 40%. Because after being assessed for tax, he has already moved from the first block or the first floor to the second floor. Do you understand? Yes? Are you following? As you get charged to tax, as your income is being charged to tax, you start moving up the slabs. So because we are already charged 37K of your NSI to tax, right? So you already moved into the second floor. Is this clear now? I'm calling it the second floor. So that's why you pay 20% on 37.7, but you already have to pay 40% on the amount of 45 minus 37.7. Is this clear? Have you understood? Okay. This is how it's going to happen. I'll just take 1 minute extra after this and explain the logic. Let me just finish this example, okay? Let me take 2 minutes extra, finish this example, so you understand what is involved, okay? Remember, the PSA is 500, very important. I'll take 5 minutes extra and finish this, okay? So this one you understood. How much is his tax liability? Oops. Here, how much is his tax liability? This one is clear to everybody. That's why everyone has to pay attention. This is not a subject where you can sit and do your own thing on WeChat. Okay, you have to pay attention, otherwise you'll get into big problems. Okay, now let's go and look at savings income. Now remember, we are already on the second floor. We are already in the higher rate HRTS. We are already here, so it's going to be 44 it's going to be at 40%. But how much will be taxed? His savings income is 7K. But remember, he has, because his TI, his total income, taxable income is 55. So it is between 38 and it is between 38 and 125. So he gets a 500 PSA. So that means that he will not be taxed on the full 7. He will get a 500 PSA. Okay. So he will be taxed at, let's look at the tax here. He will be taxed at 40% because we are already on the second floor, but not on 7K, but on 7K minus 0.5K, because that 0.5K is basically taxed at 0 rate. But actually, it's a better way of writing it is that he's going to be taxed at 0%. I've written a shortcut here. Actually, the right way to write this is that he will be taxed at 0% on 0.5K plus 40% on 6.5K. Do you understand this? Is this clear? Because the PSA is, so anyway, it's recorded, you can play back the recording, okay? So he will be, the correct way to write this would have been 0% into 0.5K plus 40% into 6.5K. That's how the 7K is going to be taxed. Yes? Is this clear? Now, the important thing is you have to keep a running total of how much income has been taxed, how much income has been subjected to tax. This is our running total. Here it was 45. Now I tax additional 7K, so it becomes 52. Why do I have to keep track of this running total? Because I'm already on the second floor. At some point I will cross into the third, I might cross into the third floor. Then my rate becomes 45%. So I have to keep track of this running total. Is this clear? The cumulative amount of income charged for tax, assessed for tax, that we have to keep a track of because we keep on moving through the floors. As income is being assessed for tax, we keep moving up through the floors, and if we go on to the next floor, our rate of tax is going to change. So we have to watch out for this. Do you guys have a class after this? Do you guys have a class? Yes? Oh, I hope I'm not holding up anybody's class. He's not. Do you have a class after this? Yeah. Yes? Okay, then I should finish up. Okay. But anyway, so we'll continue in the next class. Okay. So this is what we have to remember, that we have to keep a running total. And the important thing is that the running total is not 51.5, it is 52. Even though you get this allowance and you get 0% tax on the allowance, for the purposes of calculating the running total, the allowance is not excluded. You have to include. So the point is the running total at this point, even though you got a 0.5K exemption, the running total at this point is actually 52. It's not 51.5. It is 52. Do you understand? This is the rule. So this is the important thing, and then we'll look at other examples later on. Okay, I'll just wrap up here quickly. So that, what time is your class? What time? Ask him, just ask him what time is the class. What? Huh? What? It's 5:30. It's 3:30 now. What time is the class? At 3:30. Oh my God. Okay, I've got to finish quickly then. Okay.